These are 5 AI-focused stocks that I believe are currently undervalued, and I want to walk you through exactly why I see them that way. To evaluate these companies, I rely on a detailed cash flow-based valuation framework that estimates what a business is worth today based on the cash it can generate over time. When I apply this framework to Meta platforms, the estimated fair value comes out to roughly $867 per share, while the stock is currently trading around $648 per share. That gap suggests that Meta is meaningfully undervalued. Now, a common concern I hear about Meta is its aggressive spending on artificial intelligence. Many investors worry that the massive investment in AI infrastructure is putting pressure on free cash flow in the near term, and that concern is valid. Meta's free cash flow is being impacted, and that impact is already reflected in the assumptions used in the valuation. Looking at the numbers, Meta is expected to generate about $69 billion in free cash flow in 2025 once the full year financials are reported. In 2026, I expect that number to fall sharply to around $25 billion, reflecting a decline of roughly $44 billion as AI-related capital expenditures ramp up. In 2027, I don't expect an immediate full recovery. Instead, free cash flow is projected to rise modestly to around $39 billion, still well below the 2025 level. So the near-term pain from AI spending is not being ignored, it's fully accounted for. Another important factor influencing Meta's valuation is its evolving capital structure. Meta has been borrowing tens of billions of dollars to build data centers optimized for AI. This isn't because the company lacks cash. Meta has more than enough liquidity to fund these projects internally. The decision to borrow is strategic. By adding debt to its balance sheet, Meta lowers its overall cost of capital. The company can currently borrow at a relatively low interest rate, roughly 5.5%, and because interest expense is tax deductible, the effective after-tax cost of that debt is even lower. When you compare that to Meta's cost of equity calculated using the capital asset pricing model, the difference becomes clear. Meta's cost of equity is estimated at approximately 11.84%, more than double its cost of debt. As Meta increases its use of debt in a controlled and disciplined way, it brings down its weighted average cost of capital. That matters because the cost of capital is the rate used to discount future cash flows. The lower that rate, the higher the present value of those future cash flows. And we discount future cash flows because money earned in the future carries risk and is worth less than money earned today. A logical question at this point is, if debt is cheaper than equity, why not fund the entire business with debt and eliminate equity altogether? The answer is that the cost of debt is only low up to a point. If Meta were to over-leverage its balance sheet, lenders would demand higher interest rates to compensate for the increased risk. Just like an individual borrower, companies can only borrow cheaply as long as their debt remains manageable relative to their income. Finding that balance, the optimal capital structure, is exactly what corporate finance teams are paid to do, and Meta appears to be executing this exceptionally well. Beyond the financial mechanics, the strategic payoff of Meta's AI investment is already becoming visible. AI-powered improvements are driving higher user engagement, improving content discovery, and making Meta's platforms more engaging overall. At the same time, artificial intelligence is dramatically improving ad targeting and return on ad spend. Since advertising accounts for the vast majority of Meta's revenue, better targeting directly translates into higher revenue efficiency. Over the long run, this kind of investment is likely to generate stronger returns on investor capital. The second company I highlighted is Amazon. Amazon is also spending aggressively on AI-optimized data centers, and Wall Street has expressed skepticism about whether this level of investment will deliver attractive returns. However, Amazon's management team has a long track record of disciplined and effective capital allocation. Historically, many of Amazon's most criticized investments, from AWS to logistics infrastructure, later proved to be transformational. We're already seeing signs that Amazon's AI spending is paying off. AWS, the company's most profitable segment, has reported accelerating revenue growth. Even more telling is the rapid expansion of AWS's backlog, or remaining performance obligations, which has grown by tens of billions of dollars. That backlog represents future contracted revenue and provides strong visibility into continued demand. These trends suggest that AI-driven investment is strengthening Amazon's competitive position rather than weakening it. The next undervalued AI stock is UiPath. Based on cash flow estimates, UiPath's intrinsic value comes out to approximately $21.88 per share, while the stock currently trades near $17.33. UiPath sits at the intersection of artificial intelligence and automation. The company helps enterprises streamline repetitive business processes, reduce operational costs, and improve efficiency. With labor costs rising sharply over the past several years, demand for automation solutions has increased substantially. UiPath faced turbulence when its founder, Daniel Dines, returned as CEO after the previous CEO was forced out. That leadership transition created uncertainty and weighed heavily on investor sentiment. Since retaking the role, however, Dines has stabilized the business, improved revenue growth, strengthened annual recurring revenue, managed costs more effectively, and restored confidence in the company's strategic direction. Operational performance has improved, and the business is now demonstrating clearer execution. The fourth company on the list is Qualcomm. The estimated intrinsic value for Qualcomm is around $200 per share, compared to a current market price of approximately $169. Qualcomm is best known for its dominant position in the smartphone market, but its growth story extends far beyond mobile devices. In 2025 compared to 2024, overall smartphone unit volumes grew only modestly. However, consumers increasingly shifted toward premium devices. One of the key drivers of that shift is demand for smartphones capable of supporting advanced AI features. Premium smartphones contain more sophisticated components, higher processing power, and more advanced chips, all of which benefit Qualcomm. Higher average selling prices translate directly into stronger revenue and margins. Beyond smartphones, Qualcomm is successfully expanding into new markets. Its push into personal computers using Snapdragon-based architectures is gaining traction, with growing market share in that segment. At the same time, Qualcomm's automotive business is expanding rapidly as vehicles incorporate more advanced technology, including driver assistance systems, adaptive cruise control, lane keeping systems, and in-cabin AI features. The automotive segment is growing significantly faster than the company's legacy smartphone business, providing a powerful long-term growth engine. The final stock is CoreWeave. The estimated intrinsic value per share is roughly 103, while the stock currently trades around $91. CoreWeave specializes in building and operating AI-optimized data centers and renting out computing capacity. This allows companies like Amazon, Microsoft, Alphabet, and Meta to scale AI workloads without owning every piece of infrastructure themselves. Renting compute capacity helps enterprises manage costs, reduce risk, and remain flexible as technology evolves. CoreWeave has developed deep expertise in building these data centers efficiently and has established strong relationships with key partners, including NVIDIA, whose accelerated computing chips are central to modern AI workloads. Management has repeatedly stated that demand for CoreWeave's services exceeds current supply, a common theme across the AI ecosystem. Of course, there is risk. Historically, periods of shortage are often followed by oversupply as companies rush to meet demand. That risk exists here as well. However, AI-driven productivity gains create a reinforcing cycle. Increased supply improves efficiency, efficiency boosts productivity, higher productivity fuels new demand, and that demand supports continued investment. This virtuous cycle appears likely to persist for at least the next several years. Taken together, these five companies represent what I believe are compelling opportunities within the AI space. Businesses with strong competitive positions, long-term growth drivers, and current market prices that don't fully reflect their underlying value. This is not a financial advice. Happy investing.